President Trump is vowing to make changes to immigration crackdowns involving farm workers.
Tough subject because, look, we have farmers. I love farmers. At the same time, we have to get the criminals out of our country.
We are responsible for the food that we eat every single day. These people are not criminals.
Did you know that in just the first quarter of 2025, U.S. agricultural exports have plunged an astonishing 96% compared to last year? Imagine nearly an entire century of farming growth wiped out in months, and all while Canada quietly pockets billions in new export deals. If you thought trade wars were dry policy squabbles, buckle up. This is a crisis that threatens to reshape global food markets, shutter family farms across America, and send shockwaves through every dinner table. Stick around, because by the end of this video, you'll understand the single policy shift that ignited this collapse, the hidden beneficiaries cashing in millions, and a bombshell reaction from President Trump that has everyone talking. Right now, U.S. farmers are watching their corn, soy, and wheat orders evaporate almost overnight. Export revenues that hit $25 billion in Q1 of 2024 have cratered to just $1 billion this year, according to the latest USDA figures. That's a loss of $24 billion in 3 months, enough money to fund health care for nearly 5 million Americans. Meanwhile, Canada has stepped in to fill the gap, boosting its farm export revenue from $12 billion to $15.5 billion over the same period. Experts at the World Bank warned back in February that a new 50% tariff on agricultural imports could trigger exactly this outcome. And now, we're seeing those warnings come true in real time. But what triggered this sudden collapse? The answer lies in a single policy announcement last December, when the administration slapped punitive levies on U.S. allies and trading partners. Within 48 hours, major food buyers in Asia and Europe began rerouting orders to Canada and Brazil to avoid skyrocketing costs. In Japan, soybean imports from America dropped from 5 million tons to under 200,000 tons in a single month. That's why markets swung overnight. Soy futures tumbled 12% on the Chicago Board of Trade, erasing nearly $3 billion in farmer equity in one trading session. You might be wondering, what does this mean for everyday Americans? Food costs are already climbing. Grocery prices rose 8.3% year-over-year last month, the fastest jump since 2008. Thanks largely to tariff-driven supply shortages. Families are paying an extra $150 every month for staples like bread, milk, and eggs. Meanwhile, suppliers and farm equipment manufacturers are warning of layoffs. John Deere just announced a 15% workforce reduction in its agricultural division, putting 4,500 jobs at risk. This isn't just about lost exports, it's about a domino effect across rural communities. In Kansas, Hoffman Farms reported a 75% revenue drop, forcing them to lay off 60 seasonal workers. In Iowa, tractor sales plunged nearly 40% as farmers postponed equipment purchases. Every stage of the supply chain is feeling the pinch. Seed companies, fertilizer producers, transporters, even local feed stores are drowning in unsold inventory. And don't forget the geopolitical angle. Canada's boom isn't happening in isolation. The Canadian government sweetened deals with grain buyers by offering subsidized rail rates, slashing shipping costs by up to 20% compared to U.S. carriers. That maneuver has given Canada an unmatched price advantage, prompting major buyers like Nestle and Mars to shift contracts north of the border. Experts at the Peterson Institute estimate that Canada will gain at least $6 billion in agriculture revenue by year's end, while U.S. revenues continue to nosedive. So what's the real cost to the U.S. economy? GDP forecasts have been revised downward by 0.4% for Q3 2025, with agriculture accounting for half of that revision. Household budgets are strained, trade deficits widen, and rural bank failures are on the rise. In fact, Agribank reported a 23% increase in non-performing loans in rural areas last quarter, the highest level since the 1980s farm crisis. But the story doesn't end with economic fallout. Last night, President Trump took to live television in a rare address, blaming foreign manipulation and bad deals for America's farm collapse. His reactive tariff threat, promising even steeper levies if Canada doesn't back down, sent markets into a tailspin. Corn futures spiked 7% overnight, only to fall back as traders realized there's no quick fix. The president's dramatic on-camera reaction, complete with a pointed glare and clenched fist, has dominated headlines, sparking debates on whether politics or policy is driving this disaster. And here's the open loop you absolutely need to hear. Insiders say there's an even bigger policy announcement looming that could decide the fate of the entire Midwest. Rumors swirl about emergency subsidy packages, new trade negotiations with the European Union, and possible exemptions for small family farms. Stay tuned, because we'll reveal the draft text of these proposed bills, break down how they could reverse or worsen the collapse, and hear from the farmers who will be caught in the crossfire. Farmers across the Corn Belt are bracing for a second wave of impact as global buyers lock in long-term contracts with Canada well into 2026. In late May, the Canadian Grain Commission reported a 45% surge in futures contracts awarded through 2025 compared to the same period last year. That tells us buyers aren't just hedging short-term exposure, they're rewriting their entire sourcing strategies. Meanwhile, U.S. exporters saw their forward book for Q4 2025 dwindle to less than 10% of last year's volume. At this pace, by the time harvest starts next fall, most American growers won't have a buyer lined up, and without those contracts, farm credit lines will dry up faster than summer rain in Kansas. Behind these numbers lies a personal tragedy unfolding on the fields. In Nebraska, second-generation wheat farmer Carla Mendoza watched two of her largest overseas buyers switch to Manitoba in early June. She tells us she's already laid off half her staff and is rationing diesel fuel to keep the tractors running for the rest of the season. "We're proud of our American grain," she says, voice cracking. "But when Canada undercuts us by 20% on shipping, we can't compete." Mendoza's story is far from unique. A recent survey by the National Farmers Union found that 68% of U.S. growers expect to reduce planting acreage this year because they simply can't guarantee a buyer. In Europe, the shift is even more pronounced. Germany, historically America's top soybean importer, has diverted 80% of its 2025 demand to Canada. The reason? A combination of lower tariffs and a new rail corridor passing through Saskatchewan that cuts delivery time by nearly 2 weeks. EU Commission data shows that European buyers saved an average of $50 per ton on transport costs, money they now pass on to consumers or reinvest in biofuel production. Back in the U.S., soybean crush plants in Illinois have already cut back production by 30%, idling 2 major processing lines and threatening up to 1,200 factory jobs. This mass exodus has put enormous pressure on rural banks. AgriLand Financial reported that loan applications from the farm sector dropped by 22% in May, while non-performing loan rates climbed to 4.1%, double the national average for commercial lending. Credit officers warn that, without an immediate uptick in export volumes, they'll have no choice but to call in loans or tighten lending standards even further. That means more foreclosures on family farms and fewer resources for equipment upgrades, seeds, and fertilizer. All critical inputs for next season's crop. Consumers aren't immune. The American Farm Bureau Federation estimates that grocery bills will jump another 5% by the end of summer. For a family of 4, that's an additional $200 in spending on staples like cooking oil, cereals, and peanut butter. Restaurant chains, from fast food to fine dining, are already raising menu prices. One insider at a major burger chain told us they're exploring alternative ingredients simply to keep costs from spiraling. In some urban markets, fresh produce items like lettuce and tomatoes have seen price spikes of up to 12% in June alone. But Canada's windfall is not guaranteed to last. Behind the scenes in Ottawa, there's mounting debate over whether to maintain these aggressive rail subsidies once the global spotlight dims. Some Canadian policymakers worry about domestic backlash if taxpayers feel they're footing the bill for foreign buyers. At the same time, U.S. lobbyists are upping the pressure, pushing for a fast-track trade negotiation with the European Union that could level the playing field. If those talks succeed, scheduled to begin this month, they could introduce reciprocal tariff reductions that swing business back across the border. Meanwhile, President Trump's late-night announcement hinted at a potential carve-out for small farms under 1,000 acres. Initial reports suggest the draft language would exempt those growers from the highest tariff tier, but critics argue it's too little, too late. The Congressional Budget Office hasn't yet released its cost estimate, but early projections suggest the exemption could cost the Treasury up to $2 billion in lost tariff revenue annually. Is that enough to save the family farms President Trump keeps invoking on TV? And will major agricultural corporations lobby to keep the exemptions narrow, to protect their own interests? Another critical battlefield is currency. The U.S. dollar has strengthened nearly 5% against the Canadian dollar since the tariff announcement, making American exports even pricier. Currency analysts point out that this wasn't just a market correction, It was a direct reaction to the U.S. policy shakeup. If the Fed holds interest rates steady while the Bank of Canada eases, that gap could widen further, deepening the export slump. Traders are watching next week's Fed minutes for hints, and the outcome could determine whether this crisis is temporary or the start of a years-long realignment. As the dust settles on these policy skirmishes, one question looms larger than any tariff rate. Can U.S. agriculture reclaim its competitive edge? Some experts point to investments in precision farming and new export markets in Africa and Southeast Asia as potential lifelines. But building those relationships takes time that many farmers simply don't have. By now it's clear that this crisis demands more than quick fixes. Behind closed doors in Washington, agri-lobbyists are scrambling to draft a multi-billion-dollar relief package that could reshape the industry for years to come. Sources in the Capitol tell us they're negotiating a $15 billion emergency fund to offset lost export revenues, with carve-outs for renewable energy projects on farms and grants for precision agriculture technology. If approved, this package could inject desperately needed cash into rural economies. But there's a catch. Lawmakers are divided over whether to attach strict environmental mandates in exchange for funding. Will family farmers see real support, or will big agribusinesses write the rules and walk away with the lion's share? Meanwhile, in Tokyo and Shanghai, U.S. trade envoys are racing to salvage long-term contracts. Our interviews reveal that American negotiators are proposing supply chain resilience deals, promising priority access to U.S. crops in exchange for discounted tariffs and logistical guarantees. Yet many foreign buyers remain skeptical after seeing Canada's rapid pivot. Japan's Ministry of Agriculture warned this week that trust must be rebuilt, signaling that any new U.S. offers will face intense scrutiny. And in China, where soybean demand totals over 100 million tons annually, the door remains largely closed as Beijing weighs whether to use agricultural imports as leverage in broader geopolitical talks. At the corporate level, agribusiness giants are maneuvering too. One insider at Archer Daniels Midland tells us the company has already shifted 30% of its processing capacity to Latin America, targeting growing markets in Brazil and Argentina. That strategic pivot is designed to hedge against U.S. export volatility, but it also raises questions about America's long-term market share. Meanwhile, Deere & Company is fast-tracking development of electric tractors and drone-based crop monitoring systems, betting that technological innovation will become the next competitive battlefield. If these bet-the-farm investments pay off, they could give U.S. producers an edge, but only if farmers have the capital to adopt them, and if Congress doesn't hamstring progress with new regulations. Climate change is another wild card. Droughts in the Midwest and heat waves in the South have already reduced yields by up to 12% in some states this season, according to NOAA data. That environmental squeeze compounds the tariff-induced demand crash, squeezing profit margins lower than they've been in a decade. Yet some see opportunity. Agritech startups in Iowa and California are racing to deploy drought-resistant seed varieties and soil moisture sensors that promise up to 20% water savings. Venture capital investment in U.S. agritech reached $2.1 billion in Q1 of 2025, up 35% year-over-year, suggesting that investors believe technology can rescue the sector where policy has failed. But will farmers embrace these innovations fast enough to counteract lost export markets? Consumer behavior is shifting too. As grocery prices climb, shoppers are turning to private label brands and alternative proteins. Sales of plant-based meat substitutes jumped 18% in May, with Beyond Meat and Impossible Foods capturing headlines for securing new distribution deals. Some analysts predict the alternative protein market could hit $20 billion by 2027, siphoning demand away from traditional livestock producers. Tyson Foods reported a 5% drop in beef sales last quarter, attributing part of the decline to changing consumer preferences accelerated by current pricing pressures. If this trend continues, the agricultural collapse could catalyze a permanent structural shift in global food systems, one that leaves conventional farmers scrambling to adapt or exit the industry altogether. On the policy front, whispers of a sweeping farm bill revision have begun circulating. Early drafts reportedly include provisions to expand crop insurance programs and create market stabilization reserves for commodities like corn and soy. That safety net could cushion farmers from steep price shocks, but critics argue it risks perpetuating dependence on government support and discouraging diversification into higher-value crops. Some legislators are pushing for incentives to grow hemp, specialty grains, and organic produce, hoping to open new revenue streams. But opponents fear that shifting away from commodity crops will erode America's hard-won efficiencies and scale advantages. Amid all this, President Trump is preparing for a high-stakes meeting with Prime Minister Trudeau next month. Insiders tell us the agenda will center on tariffs, rail subsidies, and a potential bilateral agreement to restore at least part of U.S. export capacity. If the two leaders find common ground, it could be a lifeline for U.S. producers. But if talks collapse, or if one side accuses the other of reneging, it could trigger yet another round of retaliatory measures. Markets are already jittery. Soybean futures swung 4% the day the meeting was announced, reflecting trader uncertainty over North American trade relations. The human toll remains the crisis's most heartbreaking element. In small towns from Nebraska to North Carolina, main streets are shuddering as agribusinesses downsize staff. Rural school districts face budget cuts as property tax revenues fall, threatening after-school programs and bus routes. Mental health hotlines in farming communities report a 22% uptick in calls related to financial stress, a sobering reminder that economic numbers reflect real lives. We spoke with Reverend David Torres of a church in central Kansas. He says he's conducting daily funeral services for more than just declined crops. He's witnessing the death of livelihoods and the fraying of community bonds. And yet, hope flickers. Grassroots movements like Buy Local, Grow Local are gaining traction, encouraging consumers to support neighborhood farms directly through co-ops and community-supported agriculture subscriptions. Such models can insulate farmers from volatile export markets by building loyal customer bases at home. Some community banks are offering microloans to diversify farm offerings. Think artisanal cheeses or farm-to-table dinners, so farmers can tap into niche markets where margins are higher. These initiatives won't replace lost multi-billion-dollar export deals, but they demonstrate that resilience can emerge from innovation and community solidarity. In the heart of Iowa, a quiet revolution is already unfolding. Local entrepreneur and fourth-generation corn farmer Marcus Clay launched Field to Fork, an online marketplace that connects 200 Midwestern growers directly with urban consumers. In just 3 months, Clay's platform has processed $4.2 million in orders, nearly 15% of his county's typical export value. That's not pocket change for small farms. It's proof that innovation can rewrite the rules even when traditional markets collapse. And Clay isn't alone. In Wisconsin, dairy farmers have formed cooperatives to produce and ship small-batch cheeses nationwide, offsetting a 22% drop in bulk milk sales with a 40% premium on artisanal products. Meanwhile, agritech startups are moving from pilot projects into nationwide rollouts. In Nebraska, SoilSense sensor network has been adopted on 1,100 farms, providing real-time moisture and nutrient data that, according to company reports, can boost yields by up to 11% while cutting fertilizer costs by 18%. That kind of efficiency gain could translate to an extra $120 per acre, money that matters when export revenues vanish. Yet these technologies require upfront investment. The average system costs $15,000 per farm, and only 12% of U.S. growers currently have the capital to adopt it without subsidies or low-interest loans. That's where the proposed relief package could make or break the industry's comeback. The $15 billion emergency fund under debate in Congress would allocate $4 billion specifically for agritech grants, aiming to cover up to 80% of sensor and drone equipment costs for qualifying farms. But environmental lobbyists insist on tying those grants to carbon reduction targets, requiring emission cuts of 25% over 5 years. Agribusiness champions warn that too stringent rules could stall adoption and leave farmers stranded. The outcome of this legislative tug-of-war will determine whether U.S. agriculture leaps into a high-tech future or remains mired in tariff-driven decline. On the diplomatic front, U.S. trade representative negotiations have hit a critical juncture. Last week's round with the EU focused on reinstating tariff parity for agricultural goods, with American negotiators presenting data showing that U.S. export volumes plunged by 92% on average under current levies. EU commissioners responded by citing Canada's success. Canadian AG exports to Europe jumped from $4 billion in 2023 to $7 billion last year, thanks in part to those rail subsidies. Brussels is demanding identical logistical support for EU buyers of U.S. crops before even discussing tariff rollbacks. If Washington refuses, analysts warn retaliatory duties on American automobiles could be back on the table, jeopardizing a $60 billion industry. Currency markets add another layer of complexity. The U.S. dollar's recent 4% rally against the loonie has made American commodities even less competitive, but expectations of Fed rate cuts later this year could reverse that trend. Currency strategists at Goldman Sachs predict a potential 6% depreciation of the dollar by Q1 2026 if interest rates drop by 50 basis points. Such a shift could shave 10% off U.S. AG export prices, providing some relief, but timing is everything. If rate cuts arrive after Europe and Asia solidify new supplier relationships, the window of advantage may have closed. Through it all, the farm families remain the story's true protagonists. We spoke with the Ramirez family in Kansas, where third-generation wheat grower Elena Ramirez converted half her acreage to organic heritage grains after losing her largest Japanese contract. She's now selling direct-to-consumer bread kits online, charging a 30% premium over commodity flour. It's a gamble, she admits, but it's our way forward. We can't wait for policymakers to fix everything. We have to build our own path. Their success isn't guaranteed, but it illustrates the tenacity at the heart of American agriculture. As the sun sets over fields once golden with guaranteed export orders, the closing battle lines are being drawn. Will emergency subsidies and tech adoption steer U.S. farming back onto the world stage? Or will tariff politics and entrenched interests consign family farms to history? One thing is certain. The choices made in Washington, Ottawa, Brussels, and Beijing over the coming weeks will reverberate through every aisle of your local grocery store and every farm town in America. If you found this video interesting, hit that subscribe button and ring the bell so you don't miss our next report. And tell us in the comments, what would you do if your community's main industry collapsed overnight? Your story could be featured in our upcoming viewer spotlight. Thanks for watching.